how do ETF prices stay aligned with their assets? Imagine trying to keep a boat steady on choppy waters. That's kind of what happens with exchange-traded funds, or ETFs, in the stock market. Their prices can change all day long, but they need to stay close to the actual value of their underlying investments. So, how do they do that? Well, it all comes down to a process called the creation and redemption mechanism, which involves special players known as authorized participants. These authorized participants act like the boat's crew, making sure everything stays balanced. They work directly with the ETF issuer to create new shares or redeem existing ones, depending on what the market needs. When the ETF's market price is higher than its net asset value, or NAV, authorized participants buy the underlying securities in the open market. They then deliver those securities to the ETF issuer and get new ETF shares in return. They sell these shares on the exchange at the higher market price, making a profit. This extra supply of ETF shares pushes the market price down closer to the NAV. Conversely, if the ETF is trading below its NAV, authorized participants buy ETF shares on the exchange at the lower price. They then redeem these shares with the ETF issuer in exchange for the underlying securities, which they can sell at their full value. This reduces the supply of ETF shares and pushes the price back up toward the NAV. This process is called arbitrage, and it keeps ETF prices in line with their actual assets. Plus, ETFs regularly disclose their holdings, often daily, so everyone knows what the underlying assets are worth. During the trading day, they also provide an estimated value called the Intraday Indicative Value, or IIV. This helps traders see if the ETF's price is close to its real value. Because authorized participants can create or redeem shares quickly, ETFs don't need to buy or sell their underlying securities often. This keeps trading costs lower and liquidity high, even if trading volume is low. For traders and investors, understanding this process is key because it helps explain why ETF prices stay so close to their real worth. It also allows traders to spot small price differences and potentially profit from them through arbitrage. And because the prices stay aligned, options based on ETFs also reflected the true value of the underlying assets, making trading more predictable. So, in simple terms, the combination of transparent holdings, the creation and redemption process, and active arbitrage keeps ETF prices steady and true to their assets all day long.